Are you a real estate investor struggling to close consistent deals on a monthly basis? Do you know how to effectively use a DSCR loan if you're a buy and hold investor? What about if you're a fix and flip investor? Do you know how to use bridge loans or rehab loans? So this week, guys, I want to talk about DSCR loans for real estate investors that are long-term holders. And two, I want to be able to talk about bridge/fix and flip loans for investors like yourself that are short-term investors and are doing the fix and flip. So let's get into it. DSCR loans. I am not going to go into exactly what a DSCR loan is. I have many videos on the channel. Please go check it out. I want to get into the nuts and bolts of what makes a DSCR loan solid for the property you're looking to acquire. Or maybe it's a property that you have a conventional loan on and you want to do a refinance. There's two things I want you to look at. One, the debt service coverage ratio, DSCR. There are individuals out there, there are lenders out there, there are brokers out there that are telling you a DSCR ratio of 1.0 is great. Guess what? DSCR ratio of 1.0 is only going to cover your principal, interest, taxes, and insurance, which means any type of maintenance that you have to do it's going to be out of your own pocket and there's no cash flow for you. So when you are looking at properties and you're going to do a DSCR loan, take a look at being able to do a 1.25 to like a 1.35. I would suggest with the deals that I do and what I look at is a 1.50. So you've got 50% more in type of reserves or monies coming in than 1.0 where you have no safety net, no money whatsoever. How do we get to that 1.50? It's real simple. Whatever your mortgage payment is divided by your actual rent will get you a ratio. Here's the thing that I caution. We go out and we look at market rents and we think that it's going to be X. When you get a DSCR loan, you actually have to get an appraisal from a lender. That appraisal is going to show on a Schedule 1007, which is going to be what they feel is a market rent. Two things can happen out of this. One, the lender could actually use the market rents that are on that report, or two, they can use what your property is actually renting for. Typically, lenders will use the rents that are lesser of the two. So if one is $1,000, the other one is $1,100, they're going to go with the $1,000. Now, there are some lenders out there that will allow you to take the higher of the two, especially if you have a lease agreement and it's cash flowing at that dollar amount. Of course, they're going to let you use that. But if you are looking to buy a property and then it's not currently rented, it's basically vacant, what do? You have to go off the 1007. That is going to be your gospel. The thing that I don't want you guys to get hooked on here or stopped out is when you go to get your market rents, let's say the appraisal comes back, it's in line with purchase and your market rent's $1,000. You think market rent is $1,500. Guess what? Your lender that you're working with is going to only allow you to use the $1,000 off of the actual 1007. So you have to build the deal off of that. So if your rent does not cover your mortgage payment, you're in trouble and the lender will kill the deal. So before you go into applying for a DSCR loan, please make sure that you understand the DSCR coverage ratio, how it works, what rents are, and be a little bit more conservative when it comes to estimating rents for the property. Because ultimately, you don't want to be ratioed out to where the lender's just going to walk away. Now, There are times where I know in the past I've gotten emotional with an investment and it ended up being bad deal. And we all could potentially go through that. But in the end, you've got to make sure that you don't let your emotions take over. Some lenders will let you go below 1.0, but now you're just negative cash flowing altogether. You're not even covering your mortgage payment. So you're never going to make any money off of that property based upon that actual rent payment. You have to wait 12 months to raise the rents, which potentially could only be 10%. So you get yourself another $100. So now you've got $1,100 a month. So now you're potentially just breaking even or a little bit in the hole, which doesn't allow you to put away for reserves for any type of repairs, property management, so forth. Just not a good thing, guys. So price your rentals out correctly, know your rents. Not saying what the appraiser comes back is accurate or is the gospel. It's just what the lender is going to use going forward. So be aware. All right, guys, I want to switch over to fix and flip or bridge loans. Let's say you're a short-term investor. You're looking to get yourself into a fix and flip or a bridge loan. Two things here also. One, making sure that you got the property priced accordingly to where it's at today in the current state it's in. You want to keep that total purchase plus rehab budget under 65% loan to value or ARV, however you want to look at that. There are quite a bit of investors that I talk to that think you could go up to 75 or 80%. You can, but you're now going to be putting yourself in a position to where you're going to have to come out of pocket more than you would at 65% or 70%. That delta of 10 to 15 or even 20%, that's your down payment. That's your skin in the game. Because most fix and flip lenders and bridge lenders will actually allow you to come to the table just with closing costs and some capitalized interest. And that's it. And that typically is between 5 and 7, 10% of the total deal. But if you're going to max yourself out at 80%, you're just setting yourself up for failure. I'd rather be upfront and honest about it to be able to have that discussion. When it comes to the renovation budget, understand that you need to have a draw schedule put together that outlines exactly what's going to be completed in those 4 or 5 draws, whatever you're planning to do. I'm just making up steps. The mistakes I see here is the general contractor gives you high-level draws because he or she in his head knows exactly what's going to be done. Guess what? The lender doesn't know that, and the lender wants the details. And if you're not providing the details, more than likely that draw schedule is going to have to go back to the drawing board and be pretty much put back together and provided more. The lenders use 2 different ways. One is they do a draw schedule inspection where a physical person comes out, which costs you anywhere between $200 and $500. And then some of them have apps to where you can sign into the app while you're on your property and you can actually take pictures and videos and show the lender that these items in your draw schedule have been completed. But where the mistake lies is here. Your general contractor potentially could have been cutting off some corners and it ends up costing you more money. I call it the Ryan fudge factor. I always add 30% on top of my deals just to make sure. And if the 30% doesn't work and we can't stay in the confines of a 65 or 70% budget of ARV, I have to typically walk away unless there's something else that I don't see that can be changed. But ultimately, we see in these draw schedules to where that first draw schedule, let's say that first draw schedule is $50,000 and your general contractor is going through the work and ends up being $70,000. Who's going to pay the additional $20K? The lender's not. The lender's not going to come back and renegotiate the deal and add $20K. They agreed to whatever dollar amount you did. You've signed up. They've recorded the deed. We're done. That's coming out of your own pocket. And I know you're aware of that. But it's also the selection of your general contractor where he or she has this prior experience, not just in flipping houses, but working with investors that do draw schedules with lenders to understand that they stay on budget, to ensure that you're not coming out of coming out of pocket with additional monies, because ultimately it's going to cost you in the long run, which is costing you profit, which is costing you time. So vet your general contractors, do your homework. But the one last piece, I'm going to end it off here, which is a nugget, which hopefully you know about it and it's no surprise. Make sure your general contractor has a performance bond. And the bond is for the amount of the rehab work or whatever it's costing you in the deal. If it's the loan amount, whatever. That performance bond will cover you and the lender. God forbid if something happens with a general contractor, there's a dispute, something's going on. I know this all too well. I'm going through this and we're getting it wrapped up. And that performance bond has saved our bacon, because ultimately we'd be out tens of thousands of dollars off of the work. And that's where you need to be. If you want to learn more about performance bonds, reach out to me. I can connect you with a couple guys that we use. Performance bond is going to be based upon the general contractor's experience. So he or she's going to have to apply for it, go through an application. They do a background check. They also do a credit check. They want to make sure they're creditworthy. Ultimately, when the bond is executed, the bond company is going after the general contractor because he or she's the one that's deficient in the work. But it is a great tool to have. It's a great tool to share with your lender. It's a great tool to share with your private lenders. It will guarantee that the job will get completed. Either that general contractor comes back and finishes it, or the bond company brings in somebody new, or you bring in somebody new. But the job will get done, brought to the finish line, and then you can exit out of the deal. The lender's taken care of. You're moving on. All right, guys. Hope you guys have a great week. Stay safe, stay healthy. Please comment, share. Have a good one.